OG John AG is here, and listen closely, because what happened to silver on Friday was not just a crash. It was a warning shot. A metal does not fall more than 10% in a single afternoon for no reason. A market does not erase nearly $10 in one session unless something deeper is breaking underneath the surface. And the strangest part is this: the same collapse that scared weak hands out of silver may have made the long-term case for owning physical silver even stronger. That is the brutal contradiction sitting at the center of Friday, May 15, 2026. Silver got crushed. Spot silver closed around 70.52 per ounce, down 9.21 in a single day, losing more than 10.5% before the closing bell even finished ringing. Gold also dropped, closing near 4,564 per ounce, down 1.83%. But gold behaves differently in panic. Gold is the older, calmer sibling. It takes the hit, bends a little, and keeps its dignity. Silver does not do that. Silver does not quietly absorb pain. Silver bleeds. And it bleeds because silver is not just one thing. It is two things at the same time. It is a monetary metal that carries the memory of gold, and it is an industrial commodity with the nervous system of copper. So when the macro world turns hostile, silver gets attacked from both sides. It gets punished as a non-yielding monetary asset, and it gets punished as an industrial input tied to economic demand. That is the irony of Friday's session. Almost every real reason to own physical silver became stronger during the exact same week that the paper price of silver collapsed. So let's slow this down and put the facts in the right order, because the order matters. On Tuesday, May 12th, the Bureau of Labor Statistics released the April Consumer Price Index. Headline inflation came in at 3.8% year over year. The market expected 3.7%. That may sound like a small miss, but in a market already nervous about inflation, it mattered. It was also the highest reading since May of 2023. Core inflation, which removes food and energy, held at 2.8%. The market did not like that number, but it still tried to digest it. Then Wednesday arrived, and the Producer Price Index changed the entire tone. April wholesale prices for final demand rose 1.4% month over month. The consensus was sitting near 0.4%. That is not just a miss. That is the kind of number that forces the market to admit it was looking in the wrong direction. The trailing 12-month PPI reading hit 6%, the highest since December of 2022. Core producer prices rose 1% on the month and 5.2% year over year. And hidden inside the Bureau's own language was the part the market could not ignore for long. Nearly 60% of April's increase in final demand prices came from services. That matters because services inflation is the exact category the Federal Reserve has repeatedly shown it does not want to see running hot. Goods inflation can sometimes be explained away. Energy can sometimes be blamed on shocks. But services inflation is sticky. Services inflation tells the Fed that the problem is not temporary. The federal funds futures market understood that immediately. According to CME Group's FedWatch tool, the market moved to pricing an almost zero probability of a Federal Reserve rate cut at any point in 2026. Just 1 week before Friday's crash, the probability of a December rate hike was around 16%. By the close on Friday, that probability had jumped to roughly 50%. 2 weeks earlier, the same market was still pricing in 2 rate cuts for the year. Think about that. In just 7 calendar days, the market repriced roughly 30 percentage points of monetary policy risk. That is not a calm adjustment. That is the market running away from its own previous assumptions. And when the market ran, it ran away from silver, because silver pays no yield. It gives you no coupon. It does not send you an interest payment. So when the 10-year Treasury closed Friday at 4.59%, its highest reading since February of 2025, and the 2-year Treasury sat around 4.09%, the math started working against silver in the short term. Every day yields rise, the opportunity cost of holding a metal that pays nothing becomes harder for paper traders to ignore. The dollar index also firmed to roughly 98.5. Inflation expectations, according to the University of Michigan's preliminary May reading, moved to 4.5% for the year ahead, while long-run inflation expectations sat at 3.4%. And then came the consumer sentiment number, 48.2. That is not just weak. That is the lowest reading ever recorded since the survey began in 1952. Not the lowest since the pandemic. Not the lowest since the 2008 financial crisis. Not the lowest since 9/11. The lowest ever recorded. So picture the contradiction. American consumers have never been more pessimistic in the history of that survey. Inflation pressure is rising again, rate cut hopes are disappearing, Treasury yields are climbing, and silver drops 10% in one afternoon. But here's what the surface-level reaction misses. Silver's all-time intraday high of 121.67 was printed on January 29th of this year. After Friday's close near 77.52, that high sits about 36% above the current price. Even after Friday's brutal decline, silver's trailing 12-month return remains above 130%. The metal that panic sellers dumped on Friday has not changed. Its molecular structure did not change. The deficit did not disappear. The vaults did not magically refill. The Strait of Hormuz did not reopen. The physical market did not heal. What changed was the price at which the paper market was willing to hold silver. And those are not the same thing. Paper silver and physical silver may share the same name on the screen, but they do not always reflect the same reality underneath. The tape can scream one thing while the vault data whispers something completely different. Friday was one of those days. Now add another major piece to the picture. There is a new man sitting in the most powerful monetary chair in the world, and the market has not fully digested what that means. On Wednesday, May 13th, the United States Senate confirmed Kevin Warsh as the 11th chair of the modern Federal Reserve era. The vote was 54 to 45. That is the slimmest confirmation margin ever recorded for a Federal Reserve chair. Only one senator crossed party lines. The Senate Banking Committee moved the nomination forward on a 13 to 11 party line vote, the first fully partisan committee vote on a Federal Reserve chair in that committee's history. Whatever your opinion is about monetary policy, that data point is important. The person now responsible for steering American interest rates entered the role with less institutional consensus behind him than any Fed chair before him. And Jerome Powell, the outgoing chair, did not fully leave the building. He remains on the Board of Governors through January of 2028. That creates a rare dynamic. For the first time in nearly 80 years, a former Federal Reserve chair returns to the board after serving as chair. The modern market has no clean template for this kind of two-chair Fed environment. There is no easy historical analog to price. Kevin Warsh's first Federal Open Market Committee meeting as chair is scheduled for June 16th and 17th, just 31 days from this Saturday morning. That meeting matters because it includes an updated summary of economic projections, the famous dot plot. The March dot plot still showed at least 1/4 point rate cut for calendar year 2026. But after this inflation data, if the June dot plot removes that final cut, or even pencils in a hike, silver's consolidation could easily stretch through the third quarter and possibly into the fourth. Warsh's own record from his previous time as a governor between 2006 and 2011 shows clear opposition to quantitative easing when the Federal Reserve's balance sheet first crossed $4 trillion. By any honest reading, he is one of the most prominent monetary policy hawks in the public Federal Reserve record. And now he walks into his first meeting as chair with the hottest combined inflation tape in nearly 4 years sitting directly on his desk. If that combination feels clarifying, you are paying attention. If it feels disturbing, you are also paying attention. Now take that domestic picture and place it next to what was happening on the other side of the world at the exact same time. President Trump arrived in China for the first United States presidential state visit to the People's Republic in nearly 9 years. The summit lasted 2 days. It produced one announced trade result. China committed to ordering 200 Boeing aircraft. That is a real deliverable. It is not meaningless, but compared to everything that remained unresolved, it was narrow. The Taiwan question dominated the opening session. China's rare earth export restrictions, imposed in October of 2025, remained in place. The Nexperia semiconductor dispute, which directly touches American manufacturing capacity, remained unresolved. Beijing made no public commitment on rare earth supply, semiconductor flow, Iran mediation, or fentanyl precursor compliance. Treasury Secretary Scott Bessent stated that reopening the Strait of Hormuz was in China's interest, but no concrete agreement followed that statement. China still holds the rare earth hand. China still holds the semiconductor hand. And here is the piece that does not get nearly enough attention. China also holds a meaningful physical silver inventory position. So the United States left Beijing on Friday with the same inflation problem it had when it arrived, and the Strait of Hormuz remained operationally closed. That closure is not a side detail. It is part of the chain reaction. The Strait of Hormuz closure is feeding the energy shock. The energy shock is feeding the inflation shock. The inflation shock is feeding the Federal Reserve repricing. And that Federal Reserve repricing is what crashed silver's paper price on Friday. West Texas Intermediate crude closed the week near $105 per barrel, on pace for a weekly gain of roughly 10% from earlier levels. Brent crude strengthened above $109 per barrel. The International Energy Agency has already warned in its latest oil market report that the global market could remain materially undersupplied through October, even if the conflict ends next month. Iranian state media reported around 30 vessels crossing the strait since Wednesday evening. Before the war began on February 28th, around 140 ships passed through daily. That is the scale of the disruption. Saudi Arabia's oil production has fallen to its lowest level since 1990. And according to Wood Mackenzie commentary reported by RigZone, expectations for Brent crude in the first quarter of 2026, before the conflict began, had been below $60 per barrel. Brent is now trading above $100. That gap between what was expected and what actually happened is the energy shock in one number. If you are still here, then you already understand more about what moved this market than most of the surface-level commentary that flooded the financial media on Friday night. And if this kind of unfiltered primary source breakdown matters to you, consider subscribing, because this work only continues if you make it possible. Now let's move to the physical silver picture, because this is where the real contradiction lives. The London Bullion Market Association's Loco London Vault data released at the end of April 2026 showed total silver held in the Loco London Vault system at 27,454 tons. That was valued at approximately $64.9 billion and equals roughly 882 million ounces. That figure represented a month-on-month decline of 1.09 million ounces. Now compare that with the all-time peak of 34,346 tons recorded in January of 2021. Since that peak, the Loco London silver pool has drained by around 7,000 tons over 5 years. That matters because this is the pool that supports the global silver clearing system. It is smaller today than it was on any day in the 5 years before this one. Now look at the American side. COMEX registered silver, the deliverable inventory, sits around 79.88 million ounces. The delivery coverage ratio is 13.4%. That marks the 7th consecutive month below the 15% stress threshold. Back in January, COMEX warehouses saw a 33.45 million ounce withdrawal in a single week. That was 26% of registered inventory vanishing in 7 days. That is not normal. That is not background noise. That is stress showing up in physical movement. Then there is the Silver Institute's World Silver Survey 2026, published on April 15th. That report projects a supply deficit of 46.3 million ounces for the calendar year. That would be the 6th consecutive annual deficit. Total supply is forecast to contract by around 2%, while industrial demand is forecast to remain above 650 million ounces annually. Paper silver crashed on Friday. The vault numbers did not. That is the point. The equity side of Friday's session also deserves attention, because mining stocks do not simply track the price of metal. They sit at the intersection of metal prices, credit conditions, and energy costs. When those three forces turn against the sector at the same time, miners get squeezed hard. And that is exactly what happened. Fresnillo plc, the largest pure-play silver miner on the FTSE 100, closed Friday at 3,373, down roughly 9% from Thursday's close of 3,777. Anglo American fell 6.2%. Hochschild Mining dropped 6.4%. Endeavour Mining lost 6.6%. Antofagasta declined 3.7%. The mining complex helped drag the FTSE 100 down 1.18%, with the index trading around 10,250.93. The Investing.com analyst consensus places Fresnillo's 12-month price target at 3,890, which implies around 15% upside from Friday's close, with the high estimate sitting at 5,166. But that estimate was set before Friday's violent session. So the real question now is whether the conditions that created Friday's sell-off are temporary or structural. And that question has two honest answers. Let's start with the bearish case, because serious analysis requires honesty. Spot silver at 77.52 is still about 36% below the all-time intraday high of 121/67 set on January 29th. The Reuters survey of precious metals analysts places the consensus 2026 average silver price around $79.50 per ounce, which is broadly in line with where spot currently sits. That means the analyst community is not projecting a dramatic recovery. It is projecting a range. There are also real questions around industrial demand. Photovoltaic silver demand, according to EBC Financial Group commentary citing PV Magazine and Metals Focus, fell 6% in 2025 to 186.6 million ounces. It is forecast to fall another 19% in 2026 to around 151 million ounces as solar manufacturers continue reducing silver content per cell. LongE Green Energy is commercializing copper paste back contact cells. IO Solar is shipping silver-free heterojunction cells in commercial volume. The reduction of silver use in solar manufacturing is real, and it is ongoing. The iShares Silver Trust has also recorded persistent net outflows through the first quarter of 2026, including a single-day redemption during the February turbulence that represented more than 6% of the fund's assets. That was more than $2.5 billion of paper-side selling pressure that has not been fully absorbed. Then came another demand shock. On May 13th, the Indian government doubled its gold and silver import tariff from 6% to 15%. That directly hits one of the largest physical bullion markets on Earth. And the April retail sales data released Thursday showed weakness. Combine that with the University of Michigan's record-low consumer sentiment reading, and there is a real possibility that industrial demand destruction starts feeding into electronics, appliances, and other silver-consuming categories. One major American appliance manufacturer last week described its own demand levels as recession-level lows. So yes, the bearish case is real. It would be dishonest to pretend otherwise. But the bullish structural case is also real. The silver market is now facing its sixth consecutive annual deficit. The local London pool has drained by around 7,000 tons from its peak. COMEX delivery coverage sits at 13.4%, marking the seventh straight month below the stress threshold. The Strait of Hormuz, which is not just a geopolitical headline but a fundamental input into the energy economics driving inflation, remains effectively closed. Saudi production is at its lowest level since 1990. A new Federal Reserve chair with one of the most hawkish published records in modern central banking is walking into his first dot plot meeting in 31 days. The market has repriced 30 percentage points of monetary policy risk in 7 days. That means the move has been violent and fast. And historically violent fast repricings are not usually where asymmetric risk builds against the asset being sold. They are where emotional selling clears the board before the deeper structural reality has time to reassert itself. Now let's talk levels. Silver's 2026 low was recorded on March 20th at $67.91 per ounce. If silver breaks below the $70 consolidation boundary and holds there, that March low could be retested before meaningful structural buyers step back in. That is the honest downside floor. It exists and it has to be respected. But the all-time intraday high of 121.67 also exists. The distance between 77.52 and 121.67 is not fantasy. It is a gap that the structural data suggests may not be fully priced. The real question is timing. Does the macro environment allow that distance to close in the next 3 months? Or does silver compress for another 6 months before the physical market forces the paper market to acknowledge reality? That is the question silver is asking right now. The answer will come through several channels. It will come through the June Federal Open Market Committee meeting. It will come through whatever does or does not emerge from ongoing Iran negotiations. It will come through the movement or continued stagnation of physical flows through the Strait of Hormuz. And it will come through the COMEX inventory numbers that continue printing week after week beneath the noise of the price tape. So here is where things stand as Saturday, May 16th opens. Spot silver sits near 77.52. Spot gold is around 45.64. The gold-to-silver ratio has widened sharply to 58.9 from 53.6 just 24 hours earlier. The WTI July futures are near $105 per barrel. Brent is near 109. The dollar index is around 98.5. The 10-year Treasury yield is 4.59%. The 2-year yield is 4.09%. April CPI printed at 3.8% year over year. April PPI rose 1.4% month over month and 6.0% year over year. University of Michigan consumer sentiment printed at 48.2, the lowest reading in the survey's 74-year history. CME FedWatch is assigning almost no probability to a 2026 rate cut and around a 50% probability to a December hike. COMEX coverage sits at 13.4% for the 7th consecutive month below the stress threshold. The local London silver pool stands at 27,454 tons and continues declining. The Silver Institute projects the 6th consecutive annual silver supply deficit at 46.3 million ounces. Friday's 10% crash did not change any of those structural numbers. It changed the paper price. The physical reality underneath did not move. And that is why Friday was not just a sell-off. It was a separation event. The screen said panic. The vault data said stress. The bond market said higher for longer. The energy market said supply shock. The Fed market said no cuts. The consumer data said fear. And silver, sitting at the center of all those forces, took the full impact in one brutal afternoon. Now the market has to decide what matters more: the short-term pressure from yields, the dollar, and Fed hawkishness, or the long-term pressure from deficits, declining inventories, energy shocks, and physical scarcity. That is not an easy question. It is not supposed to be easy. This is the kind of market that punishes simple answers. It punishes emotional buying, and it punishes emotional selling. It rewards patience, discipline, and the ability to separate price action from structural reality. So as we move into the next quarter, watch the June dot plot. Watch whether the final projected rate cut disappears. Watch whether a hike enters the projections. Watch the Strait of Hormuz. Watch Brent crude. Watch COMEX registered inventory. Watch Loco London vault data. Watch the gold-to-silver ratio. Watch whether physical demand steps in below $75 or whether the market has to test $70 again before buyers return with conviction. Because the most important part of Friday's crash is not that silver fell. The important part is what did not fall. The deficit did not fall. The energy shock did not fall. The inventory stress did not fall. The monetary uncertainty did not fall. The political uncertainty at the Fed did not fall. The consumer fear did not fall. The structural argument did not fall. Only the paper price fell. And when paper price moves violently away from physical reality, markets eventually demand reconciliation. The only unknown is when. Now I want to hear your view. Do you think the June dot plot removes the final rate cut? Or does it go even further and pencil in a hike? Drop your answer in the comments because this is exactly the kind of conversation serious market watchers should be having right now. And remember, this video is for education and discussion only. It is not personal financial advice. I am sharing a framework for thinking through the data, the history, the market structure, and the ownership question so you can make your own decisions with your own money, your own risk, and your own responsibility. OG John AG is out.